much. Welcome, everybody. I hope you can hear us all right, or hear me all right. You know, the panel title today is Capital is Not the Problem. It's How We Allocate It. Anyone who's had to fundraise, whether you're an entrepreneur or whether you're a fund manager, if you're having a really honest conversation, will not agree with that at all, right? So one of the things that we're hoping to have today is a very honest and open conversation with you all. This conversation is an urgent conversation of our time, made even more so by lots of things that are happening globally right now. And so the question is not how much, but how we are choosing to allocate capital. In 2023, over $500 billion was raised in venture capital globally. Africa received less than 1% of that capital. Latin America, a little bit more than that, not much more. Together, these regions actually represent over a quarter of the world's population, and arguably a lot of its future. So it often feels like the problem isn't capital scarcity, it's distribution, it's access. It is what we define as being worthy of investment. And too often, what is risky is very much confused with what is unfamiliar. And we're here today to challenge that with people who are living and walking this every day. And to talk about transformative capital allocation in a way that is not necessarily only defined as building unicorns, but rather building inclusive prosperity in our countries, resilient systems, and generational opportunities. And that may come with different mechanisms, that might come with different assessments of what is considered risky, what the premium on that should be, and the time frame associated with that. So I am genuinely really honored here to be joined by some of the most thoughtful leaders. We were having a preparatory conversation now, which was more than a preparatory conversation. All of these individuals are highly experienced across multiple of these markets and are really thoughtful as they consider what does innovation, what does policy, what does investing across global growth markets look like. And so with that, I would like to actually start off with a question here. And I'm going to start with you, Dr. Meher. How do we activate local wealth to back innovation and not just rely on development finance institutions? In many of our markets, the DFIs have been the bulk of the funders. How do we go beyond the DFIs?
Thank you. Can you hear me? Mm-hmm. Okay, I'm happy to be here. It's DFIs and governments usually that actually are the seeders for the sort of venture capital. So, venture capital is a business of hunting for extreme outliers. And because of that, a venture capital partner or a company is usually constructing its portfolio according to sort of the power law. So the 10% will generate most of the outcome. Similarly, venture capital industry also follows a power law in a sense that 70-80% of the fund managers fail and only minority of them actually returns. Because of that, the LPs who are investing in VCs, who invest in startups, are taking big risks. So they understand that what they're investing in risky, uncertain ventures. Traditional wealth in a local country doesn't do that, right? And if a wealthy family in a certain country want to invest in risky business, they try to do it with established venture capital firms outside that country. So they're looking for places where there are lessons, there are actually results, so there are examples of success, or there are proof of capabilities. And neither of these two things exist today in emerging markets. They're starting to exist, but not a lot. Because of that, it's very difficult to get the local wealth, private wealth, to actually invest in local venture capital that is looking for local outliers.
And you've talked about needing a new playbook. What does that look like?
I mean, I think maybe change sort of the equity financing model in local emerging markets to be not chasing high-risk ventures. So is there a way to construct an equity fund that is maybe longer than 10 years, but it's looking for less risky businesses that can generate local value in the economy, but not necessarily going to grow to become a unicorn? So instead of constructing your portfolio to have the one unicorn, think about portfolio that can actually generate 3-4x returns or even 2x return, but without a lot of failures. So this will support the local economy, but you're not really thinking about building this unicorn that's going to go beyond your borders. So there's an opportunity to think about sort of, alternative funds like this.
Appreciate that. Honorable Minister, you have led fundraising of over $30 billion into the Nigerian economy. And very recently, an announcement was made about the establishment of a fund of funds to invest in venture capital. But looking beyond venture capital as well, there's some interesting things that are happening within the Nigerian market. A market which so often is considered too big to ignore, too exciting to ignore, and understanding that there is a great deal of innovation that is happening within Nigeria. A question I have for you is, how are you looking to build confidence and to be able to crowd in local investors beyond expecting foreign investors to get comfortable with the quote-unquote Nigeria risk?
I'm sorry, but do you mind using the mic? Nobody can hear you.
I think we need the mics all.
Yeah.
Okay. Yeah, we're working on. I think we might need some help with the mics.
Yeah.
We can just thank you.
No, we can just share here, is okay.
Coming from Nigeria, and with the announcement that you have made recently of the establishment of a fund of funds to invest in venture capital, I'd love to just step away a little bit from venture capital and look at other forms of capital and how you're looking to unleash that within the Nigerian market.
Okay, thank you very much. Okay, I'm thinking of how to start the conversation. I think one idea that we've started experimenting with is the idea of blended finance. So now, post the reform that we did, and if you know about the reform, actually caused a lot of currency volatility and economic turbulence. But now we've stabilized, and we knew we weren't going to be able to get in this sort of, we were already high risk. But if you look long term, it was moderated risk because we were taking out an existing risk, and that was going to cause some turbulence. And that was when the government stepped in with the idea of blended finance, and then blending government funding with private funding, and catalyzing specific sectors of the economy. We started with the mortgage industry. Nigeria doesn't have any mortgage industry. So if you're going to buy your home, you have to pay outrightly. So imagine putting down $1 million, $2 million to buy a home. And houses in Nigeria are quite expensive. And that wasn't really going to help the construction industry, because we identified that construction was one of those growth sectors that we could use to create massive jobs. Because if you're going to build, for example, 1 million homes, you're going to hire more than 10 times the number of that in the workforce. And so we needed to, have that sort of inclusive prosperity where we are creating jobs, lifting people out of poverty, and just getting things to move, because we knew that by removing the first subsidy, we saw the massive amount of inflation, and a lot of people were already going out of jobs. And so we started with to experiment with blending finance for mortgage to create a 30-year mortgage. How are we going to do that? We approached the pension funds. They weren't going to put their money in mortgages. Banks weren't going to do that. Private equity firms weren't going to do that. And so the government said, okay, if we put down 60% and take 60% of the risk, will you put down 40%? And they all agreed. And so that also helped us to bring down interest rate, because at that point, the commercial interest rate was going to about 35%. And so with that blending, we were able to actually issue commercial mortgages at 9%, sub 10. So it achieved two things, making it easier for people to get mortgages and finance homes at a lower cost, and then taking off most of the risk, especially the market risk. So the pension funds were very happy, and we saw funds coming in. So government is going to bring in 600 billion. Private sector will bring in 400 billion because we were targeting 1 trillion naira. And so that's working quite well. And we've seen the credit rating for those mortgages go to AAA, and we are still a B-rated country. So you can see how you can actually insulate certain investments using such kind of vehicles. The other idea we're also toying with is using guarantees, getting external credit enhancements, getting guarantees from AAA-rated entities, and helping also to insulate the risk of specific investments. And that's working quite well. We've seen that happen with some of the power projects that Nigeria has at the moment, with MEGA guarantee, for example. And now AFC, IFC, Afrexim also coming on board too. The fund of fund you mentioned is also being, we have such kind of blended financing coming in with the Afrexim providing some guarantees to de-risk, like a first loss guarantee to help crowding investments. So that's also working. And then we also think that by improving the capital market and the insurance market, the framework and the regulatory framework, they can also further de-risk investments. Because if, as an investor, your exit strategy is very clear. You know you can exit through the capital market in 5 or 10 years. You're going to put money in that market. And we know that currently we have very shallow markets and it's not really wide enough. So it still needs, there's a lot of room to improve that. So that reform is happening now with also insurance reform, so that we can also backstop a lot of those risks using insurance and reinsurance while we're looking to get DFI financing. For me, DFI financing, I prefer to have guarantees from them, because then I can then play with more room I can leverage guarantees 5-10 times, depending on how those guarantees are structured. So those are the kind of capital structures that we're now working with to de-risk more investments to come into the country.
One of the things that we all talk about and have been for as long as I've been in this industry has been about how do we unlock local capital. And there's also, I fear, a little bit of a survivor bias here, because we see the funds that get raised, we see who invests in those funds. We see less visibly the length of time it took and those who gave up. Because if you're taking 4 years to raise a fund, which is still the average amount of time, there are a lot of folks who give up. And so even as we look at who is being funded, increasingly we're finding that DFIs are actually not funding first-time fund managers. So it can be the same highly limited pool of managers who are raising their second fund or third fund, etc. And the first fund becomes very difficult. And in the same way, pipeline building is challenging. Entrepreneurship is a proven driver of prosperity. If we did not believe that, I don't think we would be in this room. But only if capital is paired with ecosystem building, inclusivity, and fit for market approaches. One of the elements of the conversation that we are having today is about what does equitable distribution look like? Who is actually getting funding? And for you, I have to ask Ritesh, as both an entrepreneur and an angel investor, what do you believe is the most underappreciated role investors can play in early stage ecosystems beyond writing checks? And in your context, who is underrepresented?
Great, super excited to be here. Actually, something very interesting that you should know about me. I'm a medical doctor who faced rejections of over 25 VCs consistently. And I realized one thing, at least in India, is any one of you a VC from India? Okay, great, then I'm safe. At least in India, what happens is, most of the VCs have never founded a company. And now, because of which, in India, there is a lot of mimetic behavior. And they look for a certain type of a founder. Now, in our case, when you talk about underrepresented founders, it's not only about gender. Obviously, gender is like, in India, we hardly have 2.2% of women founders getting VC funded, which is an abysmal number. But the larger concern is 43% of STEM students in India are women, out of which only 13% work in STEM industries, out of which only 2.1% get funded. So I think more than anything, my belief when it comes to capital is as follows. There's a small state in south of India called Kerala. Now the government came out with a very interesting mission called the Startup Village. They said that true prosperity in a small state in south of India can come from college entrepreneurship. Because college students are scrappy, they do not need millions of dollars. We will give them, say, $10,000 to create projects. Now the challenge was convincing an Indian to do something is very hard. So in the first year, only 15 startups applied, 15 students applied, but also our governments are very smart. So what they did was something which was phenomenal and eventually became a case study, and that was, they said, if you apply, we will give you a drop year with full attendance for the entire year. 15,000 people applied, 15,000 students. And out of those students, 700 startups came about. Out of those, 20 startups I personally invested as an angel investor. And out of those, 4 have given me a return of 50x and above. So my submission, when I look at capital, and I'm a product of Y Combinator, Sam Altman said something beautiful to me back in 2016 when I met him. He said, while we appreciate the role of venture capital, we also need to understand, let's assume if venture capital wasn't there, will these companies build value or not? And he said in most of the cases, venture capital works on mimetic theory. And at least in India, what happens is that if a Sequoia invests, every person in the room wants to invest. So they are trying to find, how can I buy faith? And that is the challenge. So my belief on venture capital, at least back in India, and I tried to raise capital for my co-working business. And the only reason that I wasn't able to raise capital was that I wasn't burning enough. And I said, if you need to burn, building a co-working business, it's a very simple business. You take square footage and then you sell it for a 4x value, and you need to make money on unit level. Like, it's stupid to not make money. And back then I used to convince investors that WeWork is doing it all wrong. That is not how to build a co-working business. It's a simple one. Eventually, the good part is that we didn't raise capital. That helped me retain 85% of the business with me. And we sold the business to SoftBank back to Oyo. But I realized one thing, and this is something that I tell to young founders, and that is, be scrappy, use capital wisely. And this is a very interesting stat which states, a lot of venture capital goes down the drain in not creating valuable assets. So one of the core things that we also need to understand is, while we raise a lot of venture capital, are we also using that venture capital for the right resources? And I think that is a fundamental question that needs to be answered. And Geeta, on the point of inclusion, one of the biggest challenges in capital today is AI inclusivity. Do you know how many languages India has recognized languages? 22 recognized languages, 19,500 dialects. Now talk about AI. We are in for a massive challenge because we are not developing inclusive AI. I'll give you an example. When you talk about OTT, there's a company back in India called Stage. They're basically Netflix for Bharat, creating content in these 22 languages. And the opportunity to build, I always tell VCs, and back in India, I've invested in 138 startups. A lot of VCs now come to me checking that, are you investing in this? And I think being contrarian and backing founders where no one is backing has been one of the best things that I've done. And I think that is something that we really need to figure out. And I genuinely feel platforms like the Co-Sharper Center can create a lot of impact investing, and we really need to ensure that more and more visibility comes from these kind of platforms.
Thank you so much. And you know, this again is a reinforcement of exactly what the center has been doing and has been consistently doing. I've never been in a session with the center where we're not having a real conversation with entrepreneurs at the table. And I want to turn the next question a little bit to the point of entrepreneurs. You said something now, which I think resonated with you, Annika, and that is you were able to retain 80% of the ownership of the business. So often with entrepreneurs, in that desperate search for capital, especially early on, you start giving away your right to be able to manage your business yourself. And as your cap tables get bigger and bigger and more complex, you no longer necessarily have the ability to follow the agenda that you think is the most important thing to follow. Annika, you have a incredibly rich experience investing globally. What are the challenges that you feel entrepreneurs shouldn't be facing but are? What are the risks associated with making those investments when you're looking at entrepreneurs and giving them that ability to retain control over the growth of their businesses without being held hostage to what many entrepreneurs complain about, which is a degree of almost vampirism, as they sometimes call it, behavior coming from VC and PE investors?
So PE and VC, I think this is on, okay. So private equity versus venture capital, I think slightly different in that regard. Now, I can comment on the VC front from an Africa angle. There's a nice ecosystem of startups in Africa. It's still very early stages of its development. It's really only started maybe in 2015, but truly maybe picked up in 2020 onwards. So we're really, I don't think we can draw any sort of conclusions other than maybe what happens to startups until about Series A, because post-Series A we don't have a huge number of startups. A lot of the startups are trying to fund, not enough money to fund them. Now, I think there's the tendency for the funding to go into larger markets, and there's the tendency maybe, although I question this, at least I try not to do this with our fund at Atlantica, is rushing to deals where everybody is. We also start very early. We do pre-seed and seed and then follow on. We only invest in maybe 15 startups within the fund, so with a focused strategy of support, not spray and pray. What helps founders not get diluted? I think Africa actually has an advantage here, and maybe other markets, but at least compared to the US, which is African entrepreneurs are used to not having access to money. So they're very efficient in growing their businesses and very imaginative and shoelaces and bubblegum kind of approach to it. So I think when they grow their businesses, there's a lot less money needed to get to a state compared to, let's say, a similar startup in the US. Now, if you're a rational investor, you actually do watch out to make sure that the founder is always feeling like it's his or her own business, because the moment that founder loses that sense, motivation falls. I think you doom the business's success. So for us as a VC fund, one of the things is to always make sure that when we invest, there's lots of equity left for the founder. We actually haven't invested in one startup until now. It's taken a year and a half because the founder was so diluted down by the initial sweat equity investors that her ownership was so little. We had to make sure she got a ton of equity back to herself before we could invest. We didn't want to invest beforehand because she was not motivated. So we helped her get to the point where she had a high ownership of the business. And then the other thing you need to do is as a funder is top up that founder as the businesses grow. If you don't do it, the moment the founder thinks it's my business as an investor, as much as we help or we try to help, we're doomed.
Thank you. I want to actually move into a space where we are talking about alternative capital providers, but also talk about the governance structure. Back to the question, one of the key questions of this panel, who's making the decisions, right? And there is something there that I want to unpick a little bit. So if how we allocate capital is the problem, who is making that decision? Who are the people on these investment committees, right? And there are layers of this, whether it is the limited partner into the fund manager, who's on the IC of the fund manager. I mean, the other university, which is nearby here, did some analysis some years ago, which was a bit insulting but interesting to read. They looked at 3,000 investment decisions that had been made and tried to understand what the correlation was between the gender of the people making the decision and the level of attractiveness. So good-looking men invested in good-looking male founders at a rate which was significantly higher than the alternative. I found a lot problematic with just that analysis, but there's versions of this that we can come across, right? And we immediately recognize. And so when we think about who's making those decisions, I'm trying to get to a point here. How do we change the representation of who is on those investment committees? So we know these statistics. The numbers you gave, unfortunately, Ritesh, are globally viable, right? They're globally viable in terms of, or relevant rather, in terms of women are less than about 6% of the investment community, and the capital going into women-backed businesses roughly is 3% or less. And here's the thing, we're talking about it more, but not more capital is actually being allocated. So there's this false assumption that if we're talking about it, that means that it's changing. But it actually isn't changing. So I would like to understand, if we think we are having issues with the structures that are there right now and how they're fixed, private equity, venture capital, credit funds, guarantee structures, if we want to move to something different, because we want to see inclusive growth, and we recognize, if you look at this from a gender perspective, IFC did some analysis some years ago looking at over 650 fund managers. They did this analysis with Rock Creek, globally, and they found where women were 30% or more of the investment teams of fund managers, they outperformed across pretty much every metric. Valuations were higher. The outperformance in the lowest quartile was 50% more than the performance of funds which did not have that same representation in there. You saw a higher return in terms of the IRR. Just across every metric, these fund managers tended to invest in twice as many women entrepreneurs, but we're still having issues in terms of lack of representation. A question that I'm going to actually put towards you. You are now in Fund 5. You're raising Fund 5 with your own fund management business. Who are making the decisions in your own investment committee, and what are you recognizing in terms of the dynamics of the LPs who are investing in your fund in terms of representation?
Okay, it's a not easy question. It's working.
I can chime in.
Okay, and because we have big challenges in Brazil, just to bring the money to VC, especially nowadays that interest rates are around 16-17%. So one thing that attracts private investors to illiquid investments is getting a lower interest rate. I think this is an important thing to mention. And this representation from our LPs are mainly family offices that are investing on VCs in Brazil. So usually misrepresented, mainly males that are investing in venture capital. And most of the venture capitalists in Brazil are males. So actually our fund are mainly 3 men, the VCs. And as I was mentioned before, and we have a joke in Brazil, that to become a venture capitalist in Brazil, you must be your kind of retired job. You need to be in your last job. You already done all the money that you need to retire, and now you can do VC, because it's very difficult to start a VC as your first career. So we did a lot of work to attract females to become in our investor committee, and it was difficult. I can tell you a true history. We invited an ex-entrepreneur with 2 exits to become investors in our fund. And it took me 3 months to convince her to come and work with us. And it took her 3 months to decide to leave our company. So it was 3 months to bring her and 3 months to decide to leave. Because once you start to become a VC and realize your first check will come After 10 years, like maybe 6, 7 years, it is a tough situation. So someone in the market brought her to work in a big bank with big salaries and big bonus, and it's difficult to keep and incentivize the team in the venture capital. So one of our biggest challenge is how we can perpetuate our company to the new generations of investors that are working with us, the youngers that work with us, both men and females, but to keep them motivated, because it's a so long-term investment and so long-term returns that is difficult. And during all this period, the administrative fee, which pays their salary, there is no bonus, no incentives to keep them motivated in the long term. So I think this is the biggest challenge at all, to bring diversity in VC and motivate them to keep working this kind of business.
May I add to this?
Yes, of course. And as you're getting the mic, the thing I was going to just say, what I'm hearing you also talk about is the professionalization of the industry, so that it is no longer going to be an industry where the only people who are doing this are those who are in, the last innings of their career. And there is a little bit of this which happens in some other markets, or you have the other extreme, which is you have young people who are very much interested in getting into the space, but there's significant gatekeeping which makes it hard to be able to enter.
Exactly. And I was actually going to say Africa is probably the polar opposite of Latin America or Brazil on that. Lots of young fund managers trying to raising money. But my point, the reason why I wanted to talk on this point is I don't think it's actually investment committees may matter, but the two other things that I'm going to mention I think matter more. One is the teams should be at least 50% female, because the investment committee only sees the deals that made it through the pipeline, which made it through the eyes and the lens of the actual investment team. And then one step beforehand, the LPs should pay some attention to this. And as Gita said, there's a lot of lip service on this. As a female fund manager, first-time fund manager, I felt it was, for the most part, lip service. I don't think I was advantaged. I would say I was disadvantaged by being a woman trying to fundraise. So I think it has to come a true commitment from the LP side, but the teams themselves, so the actual fund management, the GP has to be, like in our case, they're two us co-founders, but of the team, my co-founder is the only man, and I'm the only non-African in the team, in the entire team, and it's with an intention, because we need to oversaturate for a while and put, our goal is to put as many women as possible through, it's an apprenticeship model, so the apprenticeship of investing and looking at deals, and hopefully some of them go on and do greater things. One of them already joined the Nigerian government last year in the telecom ministry and the digital innovation side. So hopefully by oversaturation effort, short of that.
I understand. I have the honor of chairing an investment committee for a fund of funds that's focusing only on alternative capital providers with a gender lens in Africa. It has one LP behind that, which is the British government, who are putting money through a route which is not actually coming through the British Development Finance Institution. And what's interesting is, over the last 3 years, the pipeline is far bigger than even I had assumed, because we had opened this out to say we're not just looking for VC or PE, we're looking for alternative capital providers, and it's allowed us to look at different mechanisms. And I want to go to that for a moment. Honorable Minister, you made a comment as we were in our preparatory session where you said, we cannot eat AI, we cannot eat technological innovation. And I completely agree. It started a conversation with you as well, Ritesh, in terms of the role of agriculture. So what is being funded? If a lot of the funding is going to fintech, if a lot of the funding is going into industries and sectors which are not fully reflecting where the real economy is sitting, what we have is misfit capital. And I would love to hear a little bit more from you, Honourable Minister, and anyone else who would like to chime in here, in terms of what are the innovations in funding that we really need to be seeing if we do not want to fall back on the same mechanisms that exist in markets like the US, markets like Europe, where there's more liquidity, where there's easier access to debt, where you have the ability to have exits in a way that you don't necessarily in our market, and the pace of growth is something different.
Yeah, thank you. I think, well, we had that conversation before this panel. We had a very nice debate, well, they made it very clear that the VCs have a focus, and they just have to invest the way they invest. And it came about because we were wondering, isn't the expectations that the VCs are putting on the entrepreneurs also responsible for some of the things that we're seeing? It seems like most VCs you hear, when you hear funding, the first thing you hear is tech. In fact, the only thing you hear is tech. They're all going to tech. They're all going to high growth, something that will give you a unicorn. We hardly see investments going into real sector, food, agriculture, processing, fashion, things that actually make impact in our lives. And so that's where the main question is. I think it's about time that we begin to have people who are more focused. I don't know if it's going to be VC, because now you guys made it clear that it's not the VC's job. Maybe it's another, like you would say, alternative funding mechanism. Maybe it would be people who are, I wouldn't say altruistic, because that would be like talking about charity. People who really want to see real progress, real impact in real people's lives. Because we're not going to eat AI. Even the people who are going to be behind the AI need food. We have to move around. Social interaction, things that really matter to us as humans. We need to see more investments going into those activities, those things, not just tech. I mean, we'll get to a point where, I don't know, you will even have to innovate on AI, maybe AI times 2, because, I mean, the sort of fund that you see going into AI from the kind of investments that you're hearing coming into the US, Trump made $500 billion in semiconductor, AI, and then you hear all of these kind of figures, only tech. We want to see such similar kind of investments going into real sector, mining, agriculture, livestock, and every other part of life that really make us tick. Because then investors begin to feel, the entrepreneurs begin to feel that they're not as valuable because they're not in tech. I actually began to feel that way myself. Say, look, if I'm not that young, I can't be a tech entrepreneur. But how can I actually raise fund if I'm just going to do what I know how to do? Maybe just a little bit of whatever. So I think that model probably, I don't think it's even a model. I think it's us now looking for investors who are intentional about investing in those kind of sectors, who want to make the right kind of impact in what really matters. And don't get me wrong, I mean, you can also have 2 times, 3 times, I don't know about 10 times in agriculture, depending on what you're investing in. Now we are seeing more investments going into cocoa because cocoa price has gone up. I don't think that investment should be that way. I think that if we're looking for inclusive prosperity, sustainable investment, we should look at investing across board. Or maybe it's investor greed, I don't know. Or maybe it is FOMO, follow, and we're all following each other and trying to compete. Oh, she did 10x, I have to do 10x. Or maybe it is the expectation of those who are giving us funds. Maybe it is the expectation of those who are giving you funds. And so we have to start looking for the right sort of investors and the right sort of fund managers to manage those kind of investments to help us to invest in stable industries, in stable businesses, so that we can actually emancipate a lot more people into entrepreneurship, not just tech boys, We have to see the women you're talking about are not really all in tech. And that's why you're not seeing real, it looks like we're not investing in women. Women are in other businesses that are more emotive, that really speak to the real needs of society. Baby care, clothing, things that really make us humans. So if we have more investors looking at those other industries that are not going to be high growth or high income, you're going to find more women in that area than you'll find men. So maybe if you're really looking for more inclusivity, we should look at those kind of alternative funding mechanisms to to get to that segment of even illiterates. There are lots of people with sharp minds who didn't go to school that will give you the kind of returns that are really sticky. I.e., my Igbo businessmen in Nigeria, I mean, they are so entrepreneurial that they scale their businesses from nothing, and they are the richest set of people, and they never went to school. And they focus on real trade, real business, real industries. So I think it's having, maybe like you mentioned, maybe it's familiar. I think you mentioned in your opening statement, is it real risk, is it perceived risk, or is it familiarity that is the problem? So I think the more we have more people coming into investment industry who have a broader view of what life really is, of what society is, maybe we can find investors in that group of people. And there are also a class of investors, the old school type who don't understand technology, who actually want to put money also in real businesses. The granddads, they're the ones who understand real businesses, and you can still find investors in that category of people who would give you money for your fund to invest in such kind of businesses.
I fear that I am definitely identifying with the granddad theory, because I started my own career in traditional SME investing, and it feels like it's gone by the wayside as more space has been made for tech enablement. And so the question is, where is that capital coming from? As we look across the African continent, there are some fund managers who are looking at investing in SMEs on the private equity side. But the cost structure associated with that is so fundamentally different that you are stuck in this cycle, this constant cycle of having to raise larger and larger funds to ensure that there's a sufficient flow of management fees coming in to be able to bear that cost structure of the team that you have and the amount of activity that they are managing to put into helping these businesses grow, as opposed to investing in a far larger sum of businesses and then hoping that you're going to find the outliers, Dr. Meher, that you talked about, which is what VC is very much focused on. We'd like to open this up to questions from the audience. If I can start with you.
Should I use the microphone?
Yes, please. We'll take 2 questions, and then I think we're being given the indication to start closing down quickly.
Okay, thank you so much. I'm actually an entrepreneur who has a lot of sympathy for VC business. It's a rough business, but to some extent I question if it's not self-inflicted pain, because if we think about the portfolio structure, the mathematics behind 2 portfolios, one of 10 companies, in one of them, one single company gives a return of 10x, and in another one, 8 companies gives a return of 3x. The second one is more than twice better than the first one. So I wanted to ask how we ended up with this obsession with the power law, and is it the case that we could start moving towards a more private equity for SMB kind of structure in the venture capital industry?
Can I answer that?
Yes, please.
Fantastic question.
Fantastic.
Yeah, and I think it's the not just the venture capital industry that has fallen into that trap, but also entrepreneurship across the emerging markets. So if you come to me now with the VC and say, I have 80% certainty that I can double your money in 5 or 6 years, I will not invest in you. Even though it's a fantastic business opportunity, but I have actually committed to my LPs a different thesis. And therefore, you don't fit into the story that I told to my investors when I got that. So I'm limited to supporting you. And even if I want to support you, your valuation expectations are going to be too high for me, because companies that are similar to you, that are growing across borders, have higher valuations, and you don't intend to grow across border. And therefore, we have a mismatched expectations from the beginning of the conversation, and it's easier for the VC just to walk away. I believe, actually, that there is an opportunity to create, and we don't want to call it VC, an equity fund that partners with early stage innovative SMEs that don't desire to be on a high growth necessarily, but they desire to enter into a partnership with an investor company builder and give at the beginning maybe 30-40% of the company to build a reasonable sized company that can generate returns for both the entrepreneur and the VCs. And I look for constructs like that because I think that is very helpful for emerging markets, particularly when there are smaller markets. I mean, maybe it's not India and Brazil, but when we invest in Turkey, there are a lot of entrepreneurs in Turkey who can build easily $30, $40 million companies, but we cannot invest in them because they don't have the ambition to be a 100 million plus company.
Just complement one point, I think. It's not obsession, it's math. Because that's what's happening in practice when we're investing in tech companies. So one or two become outlier, grow super fast, and the other 18 will grow, but not grow too much. So there is a fund here in the US who invests in 75 startups each cohort. It's fun. And mathematically he proved in the, I think it's the 6th, 7th fund, that there will be part of this that will outlier and bring all the returns. So that's what's happened. That's the reality, and that's the story that attracts the LPs to invest in this kind of fund. Probably there is different kind of LPs that want to invest in a fund with less risk and less return, but since you have different vehicles to invest, like private equity, liquid investment, to attract money to VC, you need to put in the power law in place. That's what the mindset behind. It's not that you want that, that's what's happened in practice.
So what I'm going to do here is make a bit of an executive decision. I know there's a burning question coming here, but given there are a few burning questions. Okay, let me do this. I'm going to change my executive decision here. I will take 3 very quick questions, please, and I am going to ask the panelists to decide what you want to answer, and I'd like to give each of you 2 minutes to close us out. Remembering that the question that we're starting off with, or the point of this particular panel, is that capital is not the problem, it is the allocation of it which is. So with that, I'm going to walk around quickly and take 3 quick questions, please.
Very quick. My name is Milan. I'm an alumni from the school and a former Legatum fellow. Very quick question. I come from the Democratic Republic of Congo, and I spent the last year studying the opportunity of doing VC there, and my team and I landed on a venture studio model. So I was curious to hear your thoughts about that model in the context of African growth markets.
Thank you very much. Any more questions?
Hi everyone, I'm Nabras, and I'm someone who's
We need. The other question really is availability of pipelines as well. And I think there's a lot of need for us to have deliberate development of entrepreneurs. I know while we were talking then, we said sometimes you don't even find, maybe not the right entrepreneurs. You can have the ideas, but again, maybe the criteria we're using to identify entrepreneurs is also a problem. Women are soft-spoken, but you know, the male VCs, for example, the male investors want to see someone who's talking with a lot of energy. I'm not going to come talking to you with a lot of energy. But that doesn't mean that I don't know what I'm doing. And then if you're also looking for people who speak the kind of English with the right kind of accent, you probably never find them. And then you want people to tell you exactly everything. You want to see clearly from beginning to the end. Business is a lot of probability. So sometimes you may not actually have that sort of clarity to be able to tell someone, this is it, and I tell you, I give it to you. It doesn't really. So I think the model with which we also look at entrepreneurs is another thing to look at that can help a lot. And entrepreneurs, if you're here, my own advice is try and develop yourself a lot. I know everybody here is developed, you all trained, you all went to school. Well, I'm talking about local businesses, local entrepreneurs. They just have the native sense. They know how to buy and sell, but they don't even know bookkeeping. They don't even know how to tell you how much they really make. So that's where I think we need to have real development going into trying to bring up people so that we can actually increase the pipeline. And that will increase or make the ecosystem even a lot more viable. And yes, celebrate every success. It doesn't matter if it is the high unicorn, celebrate every success. Every endeavor counts. Even failures count. There's a lot to learn from failures as well. How we also manage failures is equally important. If someone fails and you boo the person and the person is so ashamed, there is no way I'm going to be incentivized as the next entrepreneur to try, because all I'm thinking about is how to fail. Because you're celebrating failure by actually making it a point of discussion. But I think the supportive system is very important. Finding the kind of support for yourself as an entrepreneur, finding the right kind of support for yourself as VCs, not competing against each other. The competition is very toxic.
Yes.
Can we find the right kind of competition within financing environment, the financing models that can help us? That is what we need to work on.
Thank you very much, Minister. This point around celebrating failures, I have been part of many discussions relating to that, and there are two things which seem to be a challenge. One is a regulatory environment which is extremely punitive when you do fail. So many of our countries, you are financially liable when a business fails, personally liable. And so how do you take that risk when you know that that is a potential outcome that may come? Over to you, please, Rodrigo.
Okay. As a VC, investing tech, and a former tech entrepreneur, I truly believe tech is super important. Why? Because it's the most powerful tool to democratization access to the people of everything. For example, knowledge. Nowadays, you can learn wherever you want through the internet. So you have an access. Fintech, you mentioned that a lot of money comes to fintech. For example, in Brazil, you used to have only 5 banks. Nowadays, Nubank, I don't know if you heard about Nubank, but it's the biggest neobank in the world with 100 million bank accounts. And they started providing bank accounts for free. Why could do that? Because of tech. So they could scale, they could provide everything for free. And nowadays, much better than the service of the other 5 banks are providing to the whole population of Brazil. Nubank expanding to Mexico, to Colombia, providing this kind of service. What's happening now with AI happened 30 years ago with internet. Internet, a lot of people, I was part of the internet bubble in 2000. Internet, they put a lot of money thinking about, we're going to make a lot of money now. They didn't make money in the short term, but in the long term, we saw what happened. This whole democratization of a lot of things. And the same thing that's happening in AI, it's happening in agri-tech, prop tech. So there is a lot of solution for the people acquiring house, having access to finance. So this is the way we think tech will change everything. And AI will be the next platform to create a lot of access to a lot of new things that we can even imagine. Maybe some of Walton and Bill Gates are imagining what's going to happen, but that's what we truly believe. And it's a way to provide and create real jobs in emerging markets. So the whole entrepreneurship, creating big companies that will generate a lot of profit, pay a lot of tax, will create a lot of prosperity in our countries. So that's what I truly believe.
And then we come full circle. I don't know how many of you know this, but the formation of the venture capital industry in the UK happened after World War II, coming from an analysis that was done called the Macmillan Gap Report. And so the government funded the establishment of this industry and the establishment of a firm which is very well known now. And the whole idea was that they needed to provide capital for SMEs to rebuild after World War II. And so when we think about this capital allocation mismatch between what I'm hearing is needed, patient, inclusive, local capital, and what's dominant, which is short-term, risk-averse, and often global north-centric in terms of what is considered to be markers of success. So I would have loved to end on a more positive note, but I think this has been a very honest and real conversation. Thank you all for your time. We have gone woefully over our time, so I see some worried faces from the Institute's team back there. Thank you all, and I encourage you to reach out and have the questions that were not answered asked directly.